Listen carefully, because what you're about to hear is not a headline. It's a structural confession. China is not randomly selling U.S. debt. China is not temporarily reallocating. China is not taking profits. China is doing something far more dangerous because it's far more mathematical. China's U.S. Treasury holdings have fallen to roughly the high 600 billions, down to about $682.6 billion as of November 2025, the lowest level since 2008. And that $688 billion number you keep seeing, that's not a myth. It's the October 2025 level, right before the next drop. Now, here's the part most people miss. Selling treasuries after the world reprices interest rates is not a geopolitical stunt. It's a forced liquidation at worse terms than the buyer once expected, because bond pricing is a machine, and when the machine changes, your safe asset becomes a locked-in loss. Now, while that's happening, global debt isn't shrinking, it's ballooning. The world is now sitting on roughly $337.7 trillion in total debt, end of Q2 2025, according to the Institute of International Finance. That's not an economy. That's a gravity well. And the U.S. system? Foreign holdings of U.S. Treasuries hit an all-time high around $9,355 trillion in November 2025, even as China reduced its share, meaning China is stepping back, but the machine keeps running because someone else is stepping in. So what is this really? It's the oldest pattern in monetary history. A reserve system expands, overextends, loses control, and then, quietly at first, participants begin moving from belief to balance sheet survival. And that outcome isn't political, it's inevitable. Because once rates reset, the past becomes unpayable, the present becomes expensive, and the future becomes a fight over who eats the loss. That's the thesis. What you're watching is not China versus America. You're watching the reserve debt machine enter its next phase, where exit becomes rational, even at a loss, because staying becomes fatal. Now let me show you the mechanism. Clean, chronological, and repeatable. Stage one is always the same. The setup. A system earns trust through stability, power, trade dominance, or military reach. Its currency, or its debt, becomes the default instrument the world uses to store value and settle accounts. The benefit is enormous. Cheap borrowing, constant demand, and global influence. Stage two, expansion and overextension. The system realizes it can issue more claims than it could ever redeem under normal conditions, because demand for the instrument is global. Debt grows faster than productive output, promises multiply, and the world applauds the illusion because the system still functions. Credit becomes policy. Liquidity becomes religion. Stage three, crisis and loss of control. Not a single-day collapse. This is crucial. It's the phase where the system's cost of maintaining itself rises. Interest rates move. Wars happen. Supply chains fracture. Inflation reappears. Political factions turn monetary tools into weapons. The system can no longer keep everyone whole. It must choose who gets paid, who gets diluted, and who gets sacrificed. Stage four, the inevitable outcome. The reserve instrument doesn't disappear overnight. It degrades. Participants diversify. The strongest insiders secure real assets. The weakest holders absorb the drawdown through devaluation, inflation, restructuring, capital controls, or implicit default. The story is always the same, only the costumes change. Now, proof. 3 case studies, same pattern, different centuries, identical machine. First case, Spain in the 16th century, when treasure became poison. Stage 1, setup. Spain becomes the dominant European power after the Reconquista and the opening of the Americas. It controls enormous inflows of precious metals, especially silver, turning Madrid into the center of imperial financing. Stage 2, expansion and overextension. Silver floods Europe. Spain borrows against future treasure shipments. It finances wars across the continent against France, the Ottomans, the Dutch revolt, using debt structures backed by expected inflows. But something happens that always happens. The inflow encourages dependency. Domestic industry weakens. Imports rise. Stage 3, crisis and loss of control. Prices surge across Europe, what historians call the price revolution. The real purchasing power of silver falls. Spain's costs rise, its war spending explodes, and its tax base can't keep up. The empire tries to borrow more to bridge the gap, because that worked yesterday. Stage 4, the inevitable outcome, defaults, not once, repeatedly. 1557, 1575, 1596. The empire does not run out of money. It runs out of trust at acceptable terms. Its creditors learn the hard rule. The issuer's power doesn't guarantee your real return. Second case, Britain and sterling when the global hub lost the plot. Stage 1, setup. In the 19th century, Britain becomes the workshop of the world. London is the financial center. Sterling is the settlement currency. The gold standard cements credibility. Britain's debt is trusted. Its institutions are admired. Stage 2. Expansion and overextension. World War I detonates the balance sheet. Britain finances war through borrowing and monetary expansion. After the war, it tries to restore the old system because reserve status is addictive. In 1925, Britain returns to the gold standard at the pre-war parity, effectively overvaluing sterling relative to economic reality. Stage 3. Crisis and loss of control. The global economy strains. Deflationary pressure hits. Britain must defend the peg by tightening policy, raising pain at home to maintain faith abroad. But pain produces politics. Politics produces instability. And instability triggers capital flight. Stage 4. The inevitable outcome. 1931. Britain abandons the gold standard. The world doesn't end that day. But the spell breaks. Reserve status shifts over time. Confidence doesn't die. It migrates. The lesson is brutal. When defending the system becomes more expensive than abandoning it, abandonment becomes rational. Third case. The United States and Bretton Woods, when the anchor snapped. Stage 1. Setup. 1944. Bretton Woods. The U.S. emerges from Moyo de Fu industrially intact, holding much of the world's gold. The dollar becomes the settlement currency, pegged to gold at $35 an ounce. The world rebuilds under a dollar-based system because the U.S. offers stability, liquidity, and security. Stage 2. Expansion and overextension. Over time, the U.S. runs persistent deficits, financing global military commitments and domestic expansion. Dollars spread worldwide. Foreign central banks accumulate dollars in treasuries. This is the reserve privilege. You export paper and import real goods. But then comes the core contradiction. If the world needs dollars for trade, dollars must flow out. If dollars flow out, gold backing becomes questionable. Stage 3. Crisis and loss of control. By the late 1960s and early 1970s, foreign claims on U.S. gold exceed what can be honored at the promised price. Confidence erodes. Countries begin converting dollars to gold. The U.S. faces the moment every reserve issuer faces: defend the promise and lose flexibility, or break the promise and keep control. Stage 4. The inevitable outcome. 1971. The Nixon shock. Gold convertibility ends. Then the 1970s. Inflation, oil shocks, and a credibility crisis that requires a Volcker-style rate hammer to reset the system. The U.S. survives, not because the laws of history were suspended, but because it adapted and because alternatives were weaker. Now, take a breath, because we're not here to admire history. We're here to diagnose the present. Apply the same machine to today, step by step. No sentiment, no ideology, just structure. Stage 1, setup. The dollar system after 2008, and especially after 2020, becomes the only game in town. The U.S. Treasury market is the deepest collateral pool on Earth. Stage 2, expansion and overextension. The U.S. and the world leverage cheap money for over a decade. Balance sheets swell. The system trains investors and governments to believe rates can stay low forever. But low rates aren't a gift, they're a condition. And conditions change. Now the key. When yields rise, bond prices fall. This is not a theory. This is the pricing mechanism. And when yields rose hard, treasuries themselves experienced historic losses. 2022 saw the Bloomberg U.S. Treasury Index post its biggest annual loss in its history, around 12.5%. So if a holder accumulated treasuries during the low-yield era and then reduced exposure after yields reset upward, the sale happens under a new price regime. That's what selling at a loss means in bond math. You're exchanging yesterday's low-coupon asset for today's higher-rate world, and the market forces the markdown. And here's why China matters. Because China was once the emblem of the reserve loop. Export goods, accumulate dollars, recycle into treasuries. That loop is now reversing. China's holdings have fallen to about 682.6 Tao in November 2025, down from 688.7 B in October 2025, and dramatically below the roughly 1316 T peak around late 2013. That is not a normal portfolio tweak. That is a multi-year structural retreat from concentrated exposure to the core collateral of the system. Undeniable. Stage 3. Crisis and loss of control. This is where people misunderstand what crisis means. Crisis doesn't mean tomorrow everything collapses. Crisis means the system can't satisfy all constraints at once. It can't keep inflation low, rates low, debt service cheap, asset prices high, and politics calm, all simultaneously. When rates rise to fight inflation or defend credibility, the price of existing debt falls. That creates losses for holders. When rates fall to protect markets, inflation risk and currency credibility rise. Either way, someone absorbs the volatility. Now look at the data point that should stop you cold. Despite China selling down, Foreign holdings overall hit a record $355 trillion in November 2025. Translation: the system is finding replacement buyers. Japan, the UK as a custody hub, Canada, others, so the market doesn't break immediately. This is exactly how Stage 3 behaves. The machine keeps functioning, but the composition changes quietly, structurally, and if you're only watching prices, you miss the migration. Check. Stage 4, the inevitable outcome. Again, this is not a movie scene, it's a glide path. What does the outcome look like in modern systems? It looks like fragmentation of reserves, increased bilateral trade settlement outside the dominant unit, higher geopolitical risk premia, and a constant fight over real yield versus currency credibility. It looks like rising issuance pressure meeting buyers who demand higher compensation. And it looks like more exits that happen not at the top, but at the moment holders decide, I'd rather lock in a known loss than risk an unknown regime change. And that is the psychological flip that ends eras. Now, let's address the objection that will be screamed in comments: if China sells, the US collapses. No, China is no longer large enough by itself to detonate the Treasury market in one strike. Even analyses note China owns only a small fraction of outstanding treasuries compared to the total market footprint. And the system has shown it can attract other buyers, at least for now. But that isn't the point. The point is, the signal is not about impact today, it's about trajectory. In every historical case, the reserve regime didn't end because one actor caused a crash. It ended because the incentive structure changed, and rational actors adapted. Spain didn't fall because one creditor sold. It fell because repeated defaults taught creditors that promises were political. Britain didn't lose reserve status because 1 week of selling happened. It lost because defending the old parity cost more than abandoning it. The US didn't end gold convertibility because someone attacked. It ended it because the system's internal contradiction became unpayable. So what is the contradiction now? It's this: global debt is enormous, and refinancing it in a higher rate world is not a theory. It's a transfer of wealth from issuers to holders. But if that transfer becomes politically intolerable, policy will seek escape routes: financial repression, stealth inflation, regulatory absorption, or forced domestic demand. And that creates the environment where foreign holders, especially strategic rivals, reduce exposure even if it costs them in the short term, because the long-term risk is not price volatility. The long-term risk is rule volatility. That is why the $688 billion exit matters. It's not the number, it's the direction. It's the admission that treasuries are not just an asset, they are a relationship, and relationships can be repriced. Now, what does this mean for you right now, practically? First, stop thinking in headlines. Think in duration, refinancing, and incentive. Bonds are not magic. When rates move, prices move inversely. Even basic duration math shows how rate changes translate into price changes across maturities. Second, stop believing this time is different, because the interface is modern. The interface always changes. The machine does not. American exceptionalism doesn't cancel arithmetic. Modern optimism doesn't refinance trillions at will. And technology will save us does not repeal the bond market. Third, position yourself like someone who understands regimes shift gradually, then suddenly. That means reduce dependence on a single narrative. Build resilience, liquidity that matches your time horizon, exposure to productive cash flow, and, yes, some allocation to assets that are not somebody else's liability. This is general education, not personal financial advice, but the principle is universal. Don't build your life on the assumption that the system's current rules will remain permanent, because history says the rules change precisely when the cost of keeping them becomes too high. And we are approaching that zone because the world is over-leveraged, politics is fractured, and trust is being replaced by enforcement. Final warning: burned into the wall like a prophecy. Reserve systems do not die from one catastrophe. They die from 1,000 rational decisions. China's reduction is one of those decisions. Foreign holdings hitting record highs while China pulls back is another decision, because it shows substitution, not stability. Historic bond losses after rates reset is another decision, because it changes behavior permanently. Global debt at record levels is the condition that forces all other decisions. This is the pattern: setup, overextension, loss of control, outcome, and you don't get to vote on it. You only get to recognize it. So here's the call to action. If you want to understand what happens next, how the machine was built, why the exits accelerate, and what stage 3 turns into when confidence finally demands a price, subscribe now, because the next video isn't about China. It's about the moment the system admits, in public, what it has already accepted in private, that the cost of maintaining the old world has become higher than the cost of replacing it.